Let's go ahead and take a look at the stock market and see how it compares with the bond market. The stock market, of course, is an area where vast fortunes can be made very, very quickly, but also an area where vast fortunes can be lost just as fast. So stocks represent ownership in a corporation and entitle owners to a share of profits through dividends, which almost works like a coupon payment for bonds, and shares are going to be traded in stock exchanges. So the New York Stock Exchange, the London Stock Exchange, the Tokyo Stock Exchange. Although the vast majority of stocks are now traded online through computers, you can go ahead and do physical sort of transactions of stocks through these locations as well. So let's go ahead and do a very, very quick compare contrast of the bond market versus the stock market. So let's go ahead and take a look at the bond market, things we already know about the bond market. So bonds, we typically say that they are going to be giving a safer return on your sort of investment compared to the stock market. And because they are considered safer, they also have a less return. So less return on your investment. The vast majority of bonds nowadays, they typically give you something less than 5%. It's very rare to see bonds giving you more than 5% nowadays. However, they are considered to be safe because you know exactly what you're going to be getting yourself into. They are seen as a form of debt. So it is a claim, it is an IOU in terms of a corporation or in terms of the government. Typically, if companies do go bankrupt, you are going to be you're going to be typically paid first after the corporation liquidates all of its sort of funds, all of its assets, because you are seen as a debtor in terms of a bond. And then finally here, you're going to be paid some type of coupon. So vast majority of bonds nowadays, they also do issue some type of coupon. And this is basically just your return for letting a firm or corporation lending them your particular money. How does the bond market compare to the stock market? So the stock market that we see right here. The stock market, of course, is where we see a lot more risk coming into play. So stocks are seen as very risky compared to bonds. They are much riskier. So, but in terms of stocks, they are going to be seen as much, much riskier because the largest amount that you can lose is going to be your entire investment. So if you put in $100,000 in stocks, the most that you can lose is going to be $100,000, your entire investment. However, in order to compensate you for this risk, they are going to give you a greater return. So greater return. Over the course of the stock market has historically returned you double-digit return, so 10% or greater, not accounting for inflation. So here, bonds typically give you maybe 5% over a long period of time. The stock market will give you 10% return over a long period of time, which is why a lot of people nowadays like to invest in stocks. If they have a greater time horizon towards environment, they are willing to take on this risk in order to get a greater return. So time in the market beats timing the market. That's sort of a common financial adage or saying that you hear nowadays. In terms of stocks, they are seen as a form of equity, so a form of ownership rather than a form of debt. If you even own one share in a particular company, say Disney, if you own one share in Disney, you can technically say that you are a part owner of Disney World. It's kind of a douchey thing to say, but it is something that you can say. Even if you own one share of a particular company, you are a part owner in that particular corporation. And then instead of giving you coupons, it gives you a dividend. So here, a dividend almost works like a coupon payment. So maybe quarterly or even semi-annually, they give you some type of dividend, which is a share of the profits of the corporation. But companies or firms, they don't have to issue dividends if you own a stock. So that's just something to be aware of. So in terms of stocks, if corporations need money, they can actually go ahead and issue some type of stock as well through the IPO, the initial public offering. And that's going to help the company raise a lot of money very, very quickly. It can be hundreds of billions of dollars in just a very short amount of time. However, that is the only time that a firm or corporation is going to be able to raise money through the IPO. If they want to raise money after they issue stock, then that's where they go ahead and issue bonds instead. So bonds are going to be a little bit more of a stable source of revenue or a stable source of money if the former corporation needs it. But stocks are going to raise money very, very quickly, but they can only do so once. So quick compare and contrast of bonds and stocks that we have right here. And just in terms of stocks, we do notice that the vast majority of companies nowadays, they do issue stocks. And that just tells us that there's going to be a very, very good reason why they do so. So eBay, Amazon, Walmart, they have all issued stocks and they have raised their money through the IPOs, and that has helped make the companies grow very, very quickly because they get that type of money at that particular moment that they issued the IPO. But there are a lot of sort of pros in terms of corporations, in terms of stocks, or just for having a firm sort of form itself as a corporation. And we do notice that while the typical companies that we do think of, they do issue stocks, there are a few unusual cases of firms issuing stocks as well. So how many of you have ever wanted to own a football team before? Well, probably a few of you are probably thinking about, yes, I do want to own a football team, but not a lot of you. But there is one particular football team nowadays that does issue stock because they are seen as a corporation. So the Green Bay Packers, as you can see right here, they're the only corporation out of the 32 NFL teams that we have nowadays, and they do issue stock from years to years, depending on what they want to do. So as you can see right here, the Green Bay Packers, the last time that they issued stock was in 2011 because they wanted to sort of renovate their stadium, Lambeau Field. So $143 million Lambeau Field expansion, and they decided to issue some type of stock. They said, hey, let's go ahead and issue 269,000 shares of stock at $250 a piece. And because Green Bay Packer fans are very, very crazy, they actually sold out of these 269,000 shares very, very quickly. And as you can see right here, over $64 million was raised from this issuance of stock. So Green Bay Packer fans, if you don't know, they're the type of football fans that basically sit in the stadium when there's a blizzard and they sit half naked with a piece of cheese on their head. There's really nothing to do in Green Bay, Wisconsin, except for beer, cheese, and football. That's exactly what they're known for. So as you can see right here, if you can issue stock, it can raise money very, very quickly in a very short amount of time. And if you wanted to go ahead and say that you are a part owner of a football team, you can go ahead and say, hey, the next time the Green Bay Packers issue some type of stock, let's go ahead and buy a share. However, this is probably one of the worst corporations to actually invest your money in. Basically, it's you give the Green Bay Packers $250, and the only thing that you get in return is a paper certificate that says, yes, you have a share of stock in the Green Bay Packers. You get the ability to purchase shareholder-only merchandise, and you get to go to their shareholders meeting every single year, because if you do issue stock, you have to have a shareholders meeting every single year. So this $250 that you give to the Green Bay Packers, that stock certificate, it's not going to appreciate in value. You're never going to see any type of profits from the team, even if they win the Super Bowl or if they do really good for a particular season. It basically is you giving the Green Bay Packers $250. But as we can see before, the Green Bay Packer fans, they are very, very crazy. Have you ever wondered how long it takes for you to get season tickets for this team? It basically takes them about 30 years for you to get season tickets for the Green Bay Packers because they are some of the most voracious football fans you have ever seen before. So basically what people do in Wisconsin is basically once families have a kid, they basically put their kid's name on the waiting list. And when the kid gets older, 30 years later, that's exactly where they can go ahead and sign up for season ticket, where they can actually get the ability to purchase season tickets. As you can see right here, here's a list of all the football teams and exactly how long it takes for fans to get season tickets. Miami Dolphins right here, they have no waiting list because our team really, really sucks. That's exactly what you expect from Miami sports. But as you can see right here, 30 years for season tickets for Green Bay Packers because they are very, very crazy. The last thing that we can want to go ahead and talk about in terms of stocks is exactly how do we price stocks. So why are prices of some stocks very, very high while the prices of some stocks are very, very low? And we can simply go ahead and take a look at an example right here with Chipotle. And the answer to this is just going to be simple supply and demand analysis. So the stock market is a typical market like we've taken a look at in chapter number 3. It's just supply and demand. The more demand there is for this particular company stock, the higher the price is going to go. The lower the demand, the lower the price is. So Chipotle, right now, roughly about $865 per share. So a very, very high price. But as we can see, when the company first issued its IPO, all the way back in 2006, the price of a share was roughly about $40. But then we see over the course of the years, the price of the share actually increased very, very rapidly. So from $40 all the way to a peak of roughly about $700 in 2015. And this was all driven due to demand. So investors, they took a look at Chipotle and said, hey, this corporation is really, really good. It's very fast growing. It's expanding very, very quickly. It has a product that people like. There's very high demand for the product. It's very healthy. It's a very healthy food product. And with this, we noticed that as demand for the stock increased, the price also shot up as well. But what happened to cause this precipitous drop after 2015? This is where the cracks begin to show in Chipotle. So the company expanded very, very rapidly. The costs were increasing as well, so the profit margins weren't as good. And also, this is where the health outbreak, the salmonella and the E. coli outbreak happened. And basically, this plummeted the stock from a peak of $750 all the way down to a low of $250. So losing nearly 60% of the stock, of the share of the value of the stock in a very, very short amount of time. The decline in demand of the share of the stock was seen very, very sort of well right here. However, once the share of the stock hit $250, it began to shoot right back up again because, hey, people decided to say Chipotle, it fixed all of its issues. It began to go on a sort of increase in their sort of expansion once again, and it reached a peak once again of nearly $900 per share, and then everything sort of plummeted once again once COVID-19 hit, and that basically affected every single sort of corporation and firm, and that's where we see a very, very big drop, but then it sort of recovered since then, and that's where it's sort of at its $860 nowadays. So simple supply and demand analysis is basically leading us into the idea of exactly how prices of a share of a company is going, how prices of a company's stock is going to be priced. So something that we've talked about often, once again coming to play right here once again. So in terms of the stock market, it's something that you can invest your own money into as well. And we want to go ahead and see why you should be investing money into the stock market right now. So in our next section, we're going to hit a little bit more on personal finance and take a closer look at the time value of money. So why money invested today is going to be compounded, is going to grow compoundedly into the next years, to see why a very small amount today can grow to a very extraordinary amount in the future. So we'll go ahead and take a look at your own personal finance as we wrap up the next few videos.